Okay, this is the second in our snow cancellation video series. The topic of this video is gains from dealings in property. Actually, I'm going to break that topic up into two videos. The first video will carry us through the problems that are part of the assignment titled Gains from Dealings in Property through page 148. And then I'll do a second shorter video that will go a little bit beyond that and just have some other examples in it that are not in the text. As I said at the end of the last video, follow along with pen and pad or a computer and jot down any questions you have, because we will begin our next live session with an opportunity for you to ask any questions you might have about this. I sent the link to the last video to a friend to just say, tell me if it works. And she said, you need context, show them where you are because it just looks weird. So I'm in my house. Here's where I am upstairs in my house. It's only a minimal disaster because I've been doing home improvements using the snow time. So Jazz's bed over there. And I'm a guy, I live alone, so I can have a giant TV and my mountain bike in my primary living area. So, gains from dealings in property. PowerPoint slides are posted, and I will be lecturing from those. And the PowerPoint slides, it's one set of slides that will encompass both this video and the second video that I mentioned. So, slide number 2. Recall, we're kind of in that topic of what is gross income. 61A1 gives us a lot of stats, including but not limited to. We also have the Glenshaw Glass definition of gross income. We know that gross income is broadly construed, and we've already seen that things like barter transactions, treasure trove, illegal income, income from the cancellation of indebtedness, those things can all be included in gross income. We also have some specific exclusions from gross income. Some of those are statutory, like the one in our prior video about damages, recoveries from personal injury or physical sickness. The gift exclusion under 102, fringe benefits 119 and 132, cancellation of indebtedness income in certain circumstances. There's a specific exclusion in 108. We'll undoubtedly encounter others as we go through the course. There's some non-statutory exclusions as well, things like bargain purchases, free samples, benefit of the provider, imputed income, things like that. So one of the things that we've also seen is that there's a realization requirement. So unrealized gains, for example, when you buy property and it appreciates, but you haven't sold it yet, it's not included in gross income, even though because of holding that asset, you are, in a sense, more wealthy. You have an accession to wealth as the stock you own, for example, grows, but there's a realization requirement before we tax you on that. Also, we looked at briefly the idea that when you get a loan, even though you get the loan proceeds, you have a corresponding obligation to repay the debt, and therefore that's not gross income. Thinking back to that formula that we had up on the board first day of class and it's posted on Twin, recall that really the first half of that formula is getting us down to this figure called the tax base. Basically things you include in gross income minus whatever deductions you're entitled to. Some things that look like gross income, but they're excluded, ultimately get you down to the tax base. We apply our tax rates to that, which we saw section 1A through D generally worked with that. That's how we figure out what the tax liability will be. We take into account credits and whatnot, but our tax base focuses on what is taxable income. And this topic, gains from dealings in property, really gives us another component of that. So thinking about amount realized and some of the key statutory provisions, the text does a really good job of laying this out. Section 1001 tells us, and notice on the slide I put in brackets because it's not actually in the statute, but what 1001A is saying is that realized gain is, and then it tells us what realized gain is. And in essence, it's giving us a formula. That formula we've written on the board, amount realized minus adjusted basis equals gain or loss realized. amount realized is referred to in Section 1001. It's defined in Section 1001B as the sum of any money or property received plus, or the sum of any money received plus the fair market value of property received. And that's only going to happen. You're only going to get money. You're only going to receive other property when you have a realization event. You'll notice on the slide under 1001A, it talks about a sale or disposition. Under 1001C, it says a sale or exchange. There's no thought behind that. That doesn't distinguish something different in 1001A versus 1001C. We're basically talking about a sale, exchange, or other disposition of property that constitutes a realization event. We'll say more about that in a minute. 1001C says that except as provided, so for example, flip over to Code Section 1031 in your code, that's like-kind exchanges. That would be an except as otherwise provided. Realized gains or losses shall be recognized. Realized gain or loss on sale or exchange of property shall be recognized. 61A3 actually says pretty much the same thing. It says gross income includes gains from dealings in property. 1001C says it, but in a different way. It just says that your realized gains are recognized. So realized gain is a concept that is different from recognized gain. Recognized gain just basically means the amount of your realized gain that you include in gross income. So 1001C and 61A3, again, in essence, tell us more or less the same thing. Now, with regard to a realization event, and now I'm looking at slide 4, the Helvering v. Broom case, and this, it's a little weird. Both of the cases in this chapter are weird in terms of the facts of the problem. Particularly the exchange of a bridge for a franchise in Philadelphia Park. But here, we've got property lease. The tenant improves the property. It's ultimately returned to the landlord with the improvement still there, still on the property. So the taxpayer ended up with property that was worth more than what they leased out. And the question is, when does the taxpayer have gross income? There were some choices. Is it when the new building is constructed by the tenant? Is it when the taxpayer repossesses the property and gets it back from the tenant? Or maybe do we just wait until the taxpayer sells the property? And the court said it's when the taxpayer gets the property back from the tenant, when the repossession occurs. Congress, though, as the text tells us, later came along and enacted Code Section 109, which changed the result and said basically you can just wait until you sell the property. Despite that bit of an overrule with Section 109 in terms of the actual outcome of the case, the logic in the case, or the rationale and the explanation of the 4 examples of realization events is still valid. And the text, again, page 131, note 2, the first sentence of that note basically puts in a nutshell the 4 realization events that were talked about in the case. We're also told that, some severance, breaking the property out into pieces and getting rid of one piece, is not necessarily required in order to have a taxable gain. The Broom case is really about the 4th element, other profit transactions. That's kind of like saying, we can't, that's kind of like 61A1 or 61A, gross income is all this stuff, including but not limited to. So a realization event is the first 3 things, plus, other profit transactions. That's kind of like saying, there's some other stuff and we can't label it specifically, but basically they're saying, hey, you get something of value from another taxpayer. So slide number 5, getting back to Code Section 1001 and 61A3, particularly 1001A, it basically gives us a formula and tells us that amount, and this is the formula we've written on the board even though we weren't yet to this topic. And it's a very simple formula, but it's very, very important. And this material, these concepts that we're talking about in this video will come up over and over and over again throughout the remainder of the course. So you really want to make sure you've got a handle on this. Some of these concepts we just touch on, like basis and adjustments to basis and whatnot, and then we have that as a specific topic, so we'll get in a lot more detail. So you don't have to understand all the parameters of it, but do understand the formula in 1001. Amount realized minus adjusted basis equals gain or loss realized, and according to 1001C and 61A3, basically realized gains are recognized unless there's something else in the code that tells us they're not. So let's look at slide 6. So in our formula, amount realized minus adjusted basis. Well, obviously we have to talk about what is adjusted basis. The text here does a good job on pages 142 and 143 of sort of laying out this statutory interconnection that helps us figure out what adjusted basis means. It's referred to in section 1001A. We have to go to 1011, which basically says, hey, basis is cost, except as, there's some other things, and we look at 1012. 1011A basically tells us that adjusted basis is the taxpayer's basis as adjusted under section 1016. When do you adjust basis? When do we have basis and then you have adjusted basis. When do you adjust basis? Well, there are 27 different adjustments that are listed in Code Section 1016A. Key ones for us, you adjust basis when, for example, you take a depreciation deduction. Why is that? Well, basis is where it represents the cost or investment you have in property. When you take a depreciation deduction, you're getting a benefit. You're getting a tax benefit. And so, in essence, you are recovering a portion of your basis, so we adjust your basis downward. In one of our problems, we'll see that the taxpayer builds an additional building on property for a cost of $60,000. Well, that's an upward adjustment to basis because you invested more. She invested more. It cost her more, this piece of property that she owned. So that's an upward adjustment in basis. So, Philadelphia Park, slide 7. Again, a kind of a strange case. It can be a little bit difficult to parse through, probably perhaps better talked about in detail if we want to go through the actual facts of the case and the, why are they in court and all that, better done in person. But really, we can break this down and get the key points. And the text even says on page 167, 146, 147, hey, here are the 3 key morals from Philadelphia Park. And when you look at it, we have a taxpayer who exchanges, there's a bridge exchange for a railway franchise, and that just seems weird. So think of it as taxpayer exchanged a boat and in return got a Tesla. So and the simplified issue, the real question in Philadelphia Park is, hey, what is your basis in this Tesla that you got back in the transaction? And again, not to be redundant of what's in the book, but these are very important concepts. The first one, we assume the basis in the property that you received is equal to the fair market value of what you received. Why is that? Well, that's the concept of tax cost basis. You have to, we calculate your gain based on the amount you realize, which is going to be the fair market value of the property you received. So that in essence is your cost in the property. That's the tax cost basis concept. Second point, presuming it's an arm's length transaction between taxpayers, in the circumstance where you really don't know what the value of the property that you received is, you can assume that it's equal to the value of the property you gave up. Makes sense if you've got 2 parties dealing at arm's length. One is going to say, well, I'm not giving you my boat unless I get a piece of property that's worth an equivalent amount back. And so the parties essentially, by doing the transaction, and again, arm's length, so somebody may be getting taken advantage of, but for our purposes, what fair market value of what you gave up equals the fair market value of what you got back in return. And I guess a little sub-corollary of that is if you have no idea what the value of either piece of property is, you can just assume that your basis in the new asset is equal to the basis of the property you gave up. But again, that's sort of a rare circumstance. Another moral is this idea of each year stands alone. That's a timing concept. When we have our chapter, our assignment that's Introduction to Flavor and Introduction to Timing, we'll have North American Oil and Idaho Power that'll talk a little bit about timing and each year stands alone concepts. The thing about Philadelphia Park and each year standing alone is that in the ultimate year that we were trying to deal with here, Philadelphia Park got a tax cost basis, even though it had not included any gain in the prior year tax return. So we looked at, the year of sale as sort of its own distinct year. In any event, there's a case Sanford and Brooks. When we get into timing in a lot of detail, we'll get more on that. But again, that's just one of the morals of Philadelphia Park that will recur. Nothing to worry about too greatly at this point. Now, getting to the problems. Problem 3-17A. We've got our taxpayer who has this 5-acre parcel of land. I believe she paid well, let me remember. I think she paid $10,000 for it. Let's see. She owns a 5-acre lot that she purchased several years ago for $15,000, and this year she sells 2 acres to an unrelated party for $10,000. So, plugging this idea into our 1001 formula, you know, the amount realized, that's easy. She got $10,000. But here she only sold a portion of the property in which she has a basis or cost of $15,000. So does she get to utilize up to $10,000 of her basis to just wipe out the amount realized and result in no gain? You know, in other words, can you use as much of your basis as you need to in the first year you need to use it to prevent yourself from having a gain? So she could say amount realized $10,000 minus $10,000 of my $15,000 adjusted basis means I have no realized gain and therefore no gross income. But that's not how it works. The regulation in section 1.61-6A says that in a circumstance like this, basis shall be equitably apportioned. And in problem 3-17A, really the only basis we have to apportion, well, the only reference we have to apportion basis is the number of acres that she has versus how much she sold. So she sold 2 of 5 acres, or 40% of her property. So presumptively she gets to recover 2/5 or 40% of her basis to use in this 1001 formula. Well, 2/5 of $15,000, 1/5 of $15,000 is $3,000. So 2/5 is $16,000, and that's why on slide 8 we see that the transaction, working it out for our taxpayer here, yields a realized gain of $4,000, which is the amount realized on the sale of the 2 acres, $10,000, minus the apportioned $6,000 of her adjusted basis. And again, here her realized gain is going to be recognized because we're not told of anything else that might cause that to be an exception. And note this fits in the accession to wealth concept because she really only has an accession to wealth to the extent she got back an amount greater than what it cost her to get that amount. In other words, to the extent her amount realized exceeded her investment or cost to do this transaction. Now, we have problem 3-17B, which throws in a little bit of a complication, which is not unrealistic. And what we're told is she still sells 2 of the 5 acres. But the 3 acres she retains is basically swampland and it's not worth much. So 2/5 of the property that she sold really encompasses 2/3 of the value of the entire 5-acre tract. And the 3 acres she retains is really only worth 1/3 of the total value of the 5-acre tract. Well, what do we do? I mean, I guess the choices we're dealing with here is it the same basis allocation we just did in 3-17A where she recovers 2/5 of her $15,000 basis because she sold 2/5 of the property? Or, and think about this from our taxpayer's perspective, taxpayer wants to recover as much of her cost as early as possible because that will reduce her taxable income in an earlier year. And remember, taxpayers want to pay taxes later rather than earlier. So if our taxpayer here gets her way, she's going to use as much of her basis in that 1001 transaction formula as she can. The question is, can she go about it? Well, if you look at 1.61-6A, the example, the second example, example 2, and so here we're in the regulation and we look to the example, which actually gives us some authority that helps us here. It basically says, the way you can read that is, it seems to suggest that equitably apportion, this idea of equitably apportioning basis, means you can do it based on the fair market value of the parts of the property, as opposed to just saying you sold 2/5 of the amount of property. So in other words, we can say you sold 2/3 of the value, so you can recover or offset your amount realized with 2/3 of your basis in the property. Keep in mind, however, that this is a taxpayer burden of proof thing. So it's the taxpayer who has to come in and show, should the IRS challenge the transaction, the taxpayer has to show, no, this is an equitable, sensible way to apportion my basis in this transaction. And recall that in this transaction, if you look at slide 9, we're saying she gets to recover 2/3 of her $15,000 basis. So she has no gain. That's good for the taxpayer. If the IRS were to challenge that, again, she would have to come in and it's her burden of proof. Here, that's pretty easy because the regulation suggests that she's doing it correctly. On the slide, is this transaction without tax consequence to Ann? Well, no, she doesn't have any gross income, but there are tax consequences going on here. Specifically in this problem, she's recovering basis. Recovery of basis, that basis offset against amount realized, basically running it through the 1001 formula, that's a tax consequence regardless of the number you come up with for the realized gain. There's some tax stuff going on here. She just lucks out at the end of the day that she doesn't have to report any income because her realized gain is 0, which means her recognized gain is 0. So that's problem 3-17B. Problem 318. Here we've got Bob. He's purchasing Boeing stock. He basically buys 100 shares at $40 a share or $4,000 worth of stock. And to buy the stock, he has to pay a $100 commission. And that's year 1. Year 3, we're told that the stock's gone up in value. It's now worth $50 a share. So his $4,000 investment is now worth $5,000. But to sell the stock, he has to pay another $100 commission. So how do we run this through our 1001 formula? Or we could say, what is his net accession to wealth? And of course, you're correct to realize that, well, no, his investment is actually more than $4,000 because he had to pay a $100 commission on the front end and a $100 commission on the back end, and those are both costs. So we've on the slide 10, this is plugged into the 1001 formula, and notice that the $100 commission he paid in the year of sale really reduces his amount realized. What he got when he sold the stock is the $5,000 minus the $100 he had to pay to do the sale. So that $100 shows up as a reduction in amount realized. Then we subtract out our adjusted basis, and his adjusted basis is really his cost to buy the stock, which is the $4,000 value of the stock plus the $100 commission he paid to buy the stock. At the end of the day, his net accession to wealth, his gain realized, his gain recognized is $800, again, as on slide 10. So, continuing with problem 3-19. Now, this is it's a real world problem. This is the way the world works and the things people do. And this one gets pretty complicated in a sense. It foreshadows depreciation and the recovery of basis through a depreciation deduction, but it doesn't require us to do all the math and figure out how much the depreciation deduction is. It just tells us the proper amount in the problem. Year 1, she buys this $100,000 piece of property. There's an $80,000 building on that, and $20,000 is the value of the land, so $100,000 total. We're told that her depreciation deduction, notice on the building. Buildings are subject to wear, tear, obsolescence. They decline in value over time. Land does not, as a general matter. Land is not depreciable. Just a tax rule there. Land is not. But land with a building on it, you apportion the value of that and you depreciate the building portion of the value and recover that basis gradually over time. The portion of your cost allocated to the land, you're only going to recover that when you have a 1001 transaction. So, on slide 11, we're told that at the beginning of year 1, obviously, this is, sort of when she bought the land, her basis is $100,000. In year 1, she takes appropriately a $2,000 depreciation deduction. That's a recovery of cost. Therefore, she has to adjust her basis downward to reflect the fact that she has recovered $2,000 of her $100,000 cost, which logically leaves her at the end of year 1 with a basis of $98,000. Now, just to explain the language appearing on slide 11, a taxpayer, you take your depreciation deduction for tax year 2018, calculated as of December 31st, 2018. Here, $2,000. So you adjust your basis downward as of the end of 2018 to $98,000. What that means is you go into 2019 with a basis of $98,000. So your end of year 1 basis is the same as your beginning of year 2 basis, because what you end the year with is what you start the next year with. That's why that's written out that way. Now, where this one gets a little tricky as you progress through the facts of the problem is we're told that in year 2, because she made a math error, that our taxpayer here only deducted $1,500 for depreciation instead of the $2,000 that a proper depreciation calculation would have told her she could deduct as her year 2 depreciation deduction. So what do we do in terms of our adjusting basis? Because you might think, well, you know, while she should have taken a $2,000 deduction, she actually only recovered $1,500 of her basis because she made a math error. So maybe we should adjust her basis downward only by $1,500 instead of the $2,000 that she could have recovered. What do we do? Well, not shockingly, you know, taxpayers make math errors. This issue has arisen before. And it's actually addressed in the statute. So, bottom line answer is she adjusts her basis downward by $2,000. Now, this is where in class I would say, you know, put your pen down or stop typing, just listen and see if this soaks in. Really, this is sort of an exercise in statutory reading with a little bit of tax concept and lingo thrown in. If you look in your code at code section 1016A, looking at 1016A, in particular 1016A2, 1016A2 says, you know, you adjust your basis for exhaustion, wear, tear, obsolescence, amortization, or depletion. That's basically your cost recovery for deterioration in value, whether it's depreciation on a tangible asset like a building or a tractor, or amortization on an intangible asset like intellectual property or something like that. Depletion is actually something you do when you're extracting mineral resources from property. But in any event, if you look at subsection 2, 1016A2, and again, this is the tax code reading and appreciating the significance that a very slight variation in a word can make. 1016A2 says that in capital A, 1016A2 cap A says you adjust basis downward for the amount allowed as a deduction. Well, how much was allowed? Well, our taxpayer took a $1,500 deduction in year 2. That was the deduction she was allowed. But if you go down to the flush language that begins but not less than, it says but not less than the amount allowable. Allowed versus allowable. What does that mean? Well, basically what the little phrase there in the flush language, but not less than the amount allowable, says whatever deduction you were entitled to for depreciation, that's the amount you adjust your basis downward by. That's the amount that was allowable even if you didn't take the full depreciation deduction you were entitled to. Again, some pretty in the weeds tax code reading. If you go get an LLM, that's the kind of stuff you'll get immersed in. If you practice law in any area, tax or not, that's the kind of thing you have to pay attention to in a statute, because words can be significant. And if you saw something like that in a code section, whether it's, you know, domestic law or tax law or environmental law or corporate law, you really want to dig in and make sure that you understand what that means and that you deal with it accordingly. And so that's what we are doing here, going back to slide 11 and just getting to the basics of, well, how in the world do we plug this into our 1001 formula or get to a basis figure, given that she screwed up and made a math error and should have taken a $2,000 deduction, was entitled to a $2,000 deduction, but only actually took a $1,500 deduction? Well, on the slide, you see that it's 2,000. And so recall on our earlier slide, she adjusted her basis downward at the end of year 1 by the $2,000 depreciation deduction she was entitled to take. Ended up with a $98,000 basis at the end of year 1 / beginning of year 2. Year 2, she should have taken a $2,000 depreciation deduction, so we adjust her basis downward by another $2,000, which leaves her with a $96,000 adjusted basis going into year 3. Now, in year 3, a couple of things happen. She builds another building on the property. We referenced this earlier. That's a $60,000 additional investment or cost in this asset, this piece of land with stuff built on it. So we adjust her basis upward by $60,000, this additional investment. Now, because she has invested additional money in a building, and recall the building itself is depreciable. So now, that's actually my alarm that's set to go off automatically on Mondays and Wednesdays to remind me to go to class. instead I'll just look at the snow and the icicles and continue with the video. Sorry about that interruption. So because she has invested an additional $60,000 in a depreciable building, she's going to get some more depreciation deduction availability, because now she's depreciating building 1, $2,000 a year, and building 2, which gives her another $1,500 a year depreciation deduction. So going forward, year 3 and beyond, her total depreciation deduction is $3,500. Okay, why do we care? Why are we sitting here adjusting basis? Why do we do the end of year 2, beginning of year 3, et cetera, et cetera? Well, because eventually she's going to sell the property, possibly. And when she sells it, we know the couple of things she's got to plug into the 1001 formula: the amount realized and adjusted basis. So we need to know in year 4, when she sells the entire property, land and buildings, for $160,000, what is her adjusted basis in the property, because that's what we plug into 1001. So slide 12 sort of lays it all out there for you in terms of the big things going on in year 3 that take us into year 4, the year of sale. She starts year 3, recall, with a $96,000 basis. She gets a bump up in basis for the $60,000 additional cost or investment. She gets a total depreciation deduction in year 3 of $3,500. That reduces basis. That's cost recovery. So her basis at the end of year 3 and going into year 4, the year of sale, is $152,500. So, not shockingly, if you flip over to slide 13, we plug it into our 1001 formula. She has a $160,000 amount realized minus her adjusted basis at the time of sale of $152,500. She has a realized and recognized gain of $7,500. Again, there's a lot of stuff going into that, but ultimately it just comes back to a very simple amount realized minus adjusted basis gives us gain or loss realized, which will be recognized absent some exception in the code. Here, obviously, the basis calculation was a little bit tricky. Philadelphia Park was where and the problem 318 with the stock was where the amount realized calculation had a little bit of complexity to it. But again, it's ultimately about getting those two numbers and doing simple math. So that is the conclusion of this video that deals with, takes us through page 148, I believe, in the text, the gains from dealings in property assignment. I will post what you might want to consider a supplemental video that just gives us a couple of more examples about this. And again, write down any questions you have, because hopefully Wednesday we'll meet in person. But whenever we meet in person again, we will begin with your opportunity to ask any questions you have or seek any clarifications you would like about the prior video and compensation for personal injuries, as well as this and any other video that we end up getting to dealing with gains from dealings in property.